What do you think over the last 25 years or truly long time frame, what do you think, how much have those teams' values, increased over that time frame? Just a guess, just real quick. So Tim, you're getting beat this time by Nathaniel. So NFL teams over the last 25 years have grown by 19.9x, right? He's right on the money there. And to put this in context,
I did not look that up in advance, I swear.
To put that in context, the S&P 500 is up 6.4 times, right? And this is not to say that that's just the average team, right? And so if you're thinking about the growth multiple of a company like a team like the Golden State Warriors, 49x, Los Angeles Clippers, 37.5x, the Dallas Mavericks, 30x, right? The New York Knicks, 28.3x.
Welcome to Critical Thinking Required, hosted by LBW. This podcast is intended for free thinkers, entrepreneurs, and knowledge seekers. Join us as we discuss relevant financial topics, explore with guests their financial journeys, and engage with experts in industries such as space, media and entertainment, real estate, and many more. Buckle up and enjoy the ride.
Welcome to Critical Thinking Required. I am your co-host for today, Nathaniel, along with my partner, Tim Bickmore. And today we have Danan Kirby from Ariel Funds. So, Danan Kirby is a vice president and client portfolio manager for the domestic U.S. equity research team of Ariel Funds. Danan serves as a liaison for the investment team and key decision makers, communicating the process and results of the firm's U.S.-focused investment strategies. In a research capacity, Danan covers financial services companies. Prior to joining Ariel, Danan was a client portfolio manager for Thornburg Investment Management, covering both equities and fixed income. Earlier in his career, he served as a federal banking regulator at the Federal Deposit Insurance Corporation during the financial crisis. And Danan is also a combat veteran of the U.S. Army and a CFA charter holder. Danan, we want to thank you for joining us today. I just wanted to give some quick thoughts when it comes to us at LBW and Ariel. That is that LBW has invested from our start with Ariel due to their acumen in the small and mid-cap space. We are big fans of your guys' investment framework and how you guys apply it. And I personally think it's said best with your motto from the Aesop fable, the tortoise and the hare, slow and steady wins the race. So with that, Danan?
Yeah, sure. I just want to give, for your listeners that aren't familiar with Ariel Investments, just a little bit of our background to sort of set the tone to, and we really appreciate your comments, Nathaniel. Our firm was founded, in the early 1980s by our founder and co-CEO, John Rogers Jr., who really as a kid loved value investing because he got gifts of stock when he was a kid, right? Which basically goes to show some of the things that you can do to set your child on the right path when it comes to investing. So it's never too early to get started. In the Chicago office, we focus on small, mid, and mid-cap value equities, where we're buying companies that are misunderstood, unloved, and mispriced for some reason in the world, where we're really trying to pick up 60-cent dollar bills. And today we're a $16 billion global asset manager. We have offices in Chicago, where I'm housed, and in New York, we have two departments, which is our international group, as well as our private equity arena. So we're nearing our 40th anniversary. So pretty happy about that and the results we've been able to generate for clients over the long term.
Awesome. Dan, thank you so much for the brief introduction. And I'm going to help try to moderate some of these questions that we have for you today. And for the audience, what we're going to do is we're going to focus on some things that I love: sports. I'm probably the only sports person in the office, to be very frank. But we're also going to talk a little bit about media too, which is Nathaniel's wheelhouse. Nathaniel loves the media space in a lot of different ways. So I'm excited to talk about it. And hopefully for at least our Wisconsin residents, and clients, they also may like some sports, Green Bay Packers, the Badgers, even the Bucks. The Bucks have been doing well, and the Brewers, they may make the playoffs. I don't know yet. So we'll have to figure that one out. But we do want to kind of take a dive into that, as Danan and the team have some competencies when it comes to these types of investments. So Danan, I am curious, you mentioned this on a call that we had with you about a month ago or so, or a couple of weeks ago, talking about sports related company valuations and how they've grown dramatically through time. I'm just curious on your overall thoughts on that specific statement.
Yeah, so we know that you're one of the sports fanatics at your firm, and sports is something that we pay attention to quite heavily at Aerial Investments. Don't know if you knew this or if Nathaniel knew this, but John Rogers, again our founder and co-CEO, is actually the only person that I know where there's actual like video evidence where he actually beat Michael Jordan in a one-on-one game of basketball. He's also a minority owner in Chicago Sky, as well. Melody Hobson, our co-CEO, is a newer LP owner in the Broncos. So suffice it to say, we have a little bit of area of expertise when it comes to sports and media. So we're in that game. So to your question on sports valuations, I want to turn it back on you and Nathaniel a little bit and ask a question on what do you think over the last 25 years, or truly long time frame, what do you think is sort of how much have those teams' values increased over that time frame? Just a guess, just real quick.
Over the last 25 years, I mean, I bet if I'm looking at like a compounded growth rate, I would say that they're probably at 20% year over year, at least. I would probably put that range in there. I don't know, Nathaniel, what are your thoughts? I mean, because it's grown so much in popularity in the last 25 years.
I'm going to go with multiples for my answer and go with 20 times appreciation.
So Tim, you're getting beat this time by Nathaniel. So NFL teams over the last 25 years have grown by 19.9x, right? He's right on the money there. And to put this in context,
I did not look that up in advance, I swear.
To put that in context, the S&P 500 is up 6.4 times, right? And this is not to say that that's just the average team, right? And so if you're thinking about the growth multiple of a company like a team like the Golden State Warriors, 49x, Los Angeles Clippers, 37.5x, the Dallas Mavericks, 30x, right? The New York Knicks, 28.3x. This is to say that these organizations and sports valuations, those organizations have grown at an incredible rate over the last 25 years through the stewardship of the patient investing style of very wealthy private investors. And the broader media ecosystem surrounding sports has grown substantially as well. Now, of course, not all sports teams and sports leagues are the same. So the NFL being at the top, when you have the NBA averages 19.6x, which is still great, right? The MLB at 16.5 times and the NHL at 12.1, there's some differences. Of course, NFL is the crown jewel of sports and always will be. But that just gives a context for your listeners versus a 6.4 times with the S&P 500, which is awesome over the last 25 years. Sports is even bigger, right? But most people don't really realize that as public market investors, if you're not a rich person, that you can't have access to that. And in some ways, we give access to that through some of the companies we're invested in the Aerial Fund and broader strategies. But it's just an area of the marketplace that just isn't usually looked at by investors, advisors, what have you.
That is fascinating. And I'll give Nathaniel credit on that one. He nailed that question without even looking it up. And I mean, and to think about that overall growth in that market is crazy. I mean, even I know like the Golden State Warriors, for example, they've had a decent amount of growth over time. And even the Clippers valuation, when I believe who bought that, the Microsoft co-founder ended up buying the Clippers at a pretty interesting valuation as well, has been really fascinating to watch. I am curious outside of that, when it comes to sports and media and how it's viewed from the lens of private investing, and how do public investors be able to have access to this? Like you just mentioned it, some people through the Aerial funds can have some type of exposure to these types of companies, but how do you get access to it within the public space instead of these larger private families or individuals who can go ahead and buy a sports team?
Yeah, so that's a great question, and one that's near and dear to our heart, obviously. So Ariel Investments, we're all involved in publicly traded organizations, right? And so you have to go off the beaten path and look. So I'm just going to name a few companies that are out there within the public equity sphere and sort of their market caps. You can get an idea. Fubo TV, right? If you're familiar with the streaming platform Fubo TV, right now it's at about an 866 million dollar market cap, right? You have the Atlanta Braves, which is actually publicly traded at $1.5 billion market cap. You have Sinclair Broadcasting Group, again, who's in there in the media space. Madison Square Garden Entertainment, which we hold in our portfolios. Manchester United, which is interestingly enough traded on the NYSE. You have World Wrestling Entertainment, right? And you have Under Armour, you have Nike, DraftKings, the Endeavor Group that owns UFC, Churchill Downs, Caesars Entertainment, Formula One, Paramount, Fox, Live Nation, Take-Two Interactive. If you have kids that are gamers and whatnot, there's a number of ways that you can take and have access to this ecosystem. This is not to say that all of these are great companies and should be in your portfolio, because it does take some valuation work and looking at the opportunity set. But most people don't think about those companies when they think about sports, but they are inextricably intertwined with the space, and you can get access to the growth of sports, media, live entertainment, etc., as part of your portfolio to participate in that growth over the long term.
And Dan, out of curiosity with that, how, and just for the audience, because people may not know, how are some of those companies tied to that direct live entertainment or growth market? I know, for example, a lot of people talk about the selling of TV spots, right? That's a big conversation, or even the Super Bowl ads are a big conversation of how do I get on to this, be a Super Bowl ad, how much money is being spent specifically on a 30-second ad. But could you explain just how those are intertwined from not necessarily owning the NFL team, but participating in with the NFL team in a larger scope?
Yeah, it's either participating in live media and or sports related media, whether that be through streaming services, right? Whether that be through ESPN, ESPN Plus, Disney, right? Whether that be through Paramount Global with the European soccer leagues and whatnot, being available on Paramount Plus and that platform, whether it be through companies that are gaming companies like DraftKings, FanDuel, etc. You can interact with the broader system for media betting, sports betting, as well as Comcast. Comcast is going to be one of the organizations that's in there as well. You think the pay TV bundle, one of the best economic cases for the pay TV bundle is sports, right? If you're a sports fan and a true sports fan, I don't think the economics get better for you, because you don't have to pay $30 here, $30 there, $30 there. Did you actually stick with the sports bundle? I don't know how people make some of the choices on direct to consumer, though that is still being figured out in the broader sports media ecosystem, right? You have folks like Paramount who are attempting to figure that out as well. So and then if you're thinking about from not on the growth, from not on the value side, but on the growth side, organizations like I mentioned, Take-Two Interactive, right? That space within the context of, if you're talking to someone who is below the age of 18, they're going to be on that, that 2K, right? They're going to be on those games that are playing, and that's really access to the growth of sports there. So while you may not have access to own the direct teams themselves, unless you're interested in the Atlanta Braves or Manchester United or something like that, you can play more broadly in the ecosystem. Now, if me and Nathaniel, we can get into broader arguments about the valuations of some of these organizations and whether or not those things make sense at this particular juncture in time. So you don't want to be haphazard with your analysis of the organizations, because again, media rights have really led to part of a real feeding frenzy in the valuations of these organizations, right? And if you want to play in the streaming space, if you want to play in media, not having sports basically leaves you dead in the water, right? And that means that you're going to have to pay up for the media rights. And if you look at the media rights and the recent deals that have been struck in the marketplace, they continue growing and growing and growing in value. And of course, that's an expense for some of the media related organizations. And you've seen some of the streaming services as of late taken on the chin in the marketplace, right? Because there's been overspending in that area. So you have to be intelligent about the companies, their business models, the way in which they are trying to interact across all of the verticals. And then on top of that, there's the additional complexity of the fact of the matter is there's the Gen Z, the oldest Gen Z is 25 years old. They still have some money to spend, but they consume media very much so differently than I might as a geriatric millennial.
I find that funny that you call yourself a geriatric millennial because you're on the top end of the millennial spectrum. Is that right?
Yeah, I'm the top end of the millennial spectrum, and I might have not have called myself that had my son not mentioned it to me when I refused to get on the streaming platforms or some of the platforms out there like TikTok and whatnot.
Mm.
And those too are areas where people are spending lots of money on advertising and sports too as well. Something that I think is really interesting from the media standpoint, and we can get into this when we talk about valuations. But short form video is huge. One of the organizations that I think have somewhat cracked the code on that would be NBA relative to the others, right? If you think about highlights, if you think about all of those videos, that's a way to interact with and grow the space overall and to reach new audiences that may not be tuning in to all of the games at time.
So that actually brings up an interesting point that I wanted to hit in earlier commentary from you on that, which was that you alluded to a number of tech companies, other streaming companies making bidding up these rights to stream these sports. And I read an article today in the Fierce Video publication with regards to Roku is redesigning their interface because now there is an abundance of apps to stream from. And I'm interested more particularly in your thoughts with regards to these tech companies are buying these Amazon just announced their bidding and have bought the NFL ticket for I don't even know, Thursday, Monday nights. I don't know the difference. That's just not my cup of tea. But my point is, like, all of these different providers are buying up these rights, but all of these disparate sources, the value of the cable bundle was to provide all of these sports in one place with one subscription. And we've deviated from that in the last 5 to 10 years. I'm curious on your thoughts with regards to that phenomenon. And do you think it's going to continue in that fashion, or do you think that there's going to be a rebundling of sorts? And then what would the result of that be for sport companies out there that are selling these rights to consumers via these disparate streaming services?
Yeah, I think you've hit the nail on the head, a few times there in your question. I think the old saying is, how do you make money? And well, you bundle something, then you unbundle it, and then you rebundle it, and that's where the money is made. And that seems to be what is happening with sports media right now. And we're of course in a time of dynamic change. So there's live sports have maintained and elevated their position in sort of the media value chain overall, and the must-have nature of the content continues to be a crucial pillar for broadcast cable networks. Take PP bundle, which it's declining, but it's still very material in terms of revenue for these organizations overall. At the same time, sports continues to be a key funnel point for differentiation for streaming services, right? Especially amid the fact that more scripted content looks commoditized and expensive. And part of the issue is that to your question is how many services is too many services? And I think certainly right now, what we are experiencing is the fact that there are way too many services, right? And so there's likely to see a consolidation, but we don't yet know who the ultimate victors are going to be in this battle, right? One of the things I found really interesting is that, this year, to your earlier point is the fact of organizations like Apple, and Amazon, who have incredibly deep pockets, have entered the fray and really changed the economics of the sports media arena. The money that they can spend dwarfs other people, right? It's a rounding error in the context of their expenses, right? And that's caused the media rights to have drastic inflation overall. But this will eventually come to an end, right? You have people who actually have to be rational. You've seen that in valuations since, I'd say, November of 2021 of a lot of these organizations have come down significantly. Quite frankly, they were spending too much on this media content. And so you have to be careful, right? You have to be selective. Where do you have the opportunity to move the needle for any organization over time, whether that be through your own service, whether that be through a regional sports, network, and how do you protect the underlying economics? Because the economics to a DTC model isn't as good as the paid TV bundle was, right? Where you have people who are not watching the content somewhat subsidizing the people who are. And so you have to be intelligent about it and not blow up your own economic model, depending on what company you are. You have to be careful. But it's a very tough situation for some of these organizations that are out there. At the end of the day, there's going to be some major consolidation, and people are going to have, a come to Jesus moment on, hey, maybe I, can't afford that. Maybe I don't have to have 17 different streaming services in order to watch sports. And the winner of that is ultimately going to be the consumer. But it's going to take some time.
Agreed.
Ultimately, I think it's a long-term change, and I'm not going to, I'll try to stay away from the specific companies, if you will. But I will say, generally speaking, when it comes to this type of material, it's the people who have the deepest pockets that end up winning, right? And they have the ability as well, if they do have those sort of traditional linear relationships too as well, in order to leverage those over time, right? ESPN, has found itself sort of within a bit of a crunch period, I think, along with organizations like, and you'll have other business models where they decided to dodge the whole direct-to-consumer piece, like Fox, right? And I think that that will be viewed as very smart, because you didn't spend all this money, right, over the course of time and potentially lose it. But you have a lot of the big players that are out there, I think, are going to sort of survive the ultimate streaming wars. And to me, that, that includes, Fox, that includes, Comcast is going to survive. That includes Paramount, because they have other businesses that they don't have to just depend upon that direct to consumer space in there. And to be blunt and to be fair, the world doesn't change all that fast, right? It doesn't. And that is one of the pieces that people, tend to forget in a world where growth mostly dominated the last 12 years. Everyone was going to be disrupted, right? New technology was going to change everything. We were going to have self-driving cars by, 2025. Lo and behold, those things haven't happened. And it's the same thing with these companies that believe that they can grow to the sky, where you can't necessarily. So everyone takes a little bit of a valuation hit. People right now, again, having the come to Jesus moment. But the winners are going to be largely the incumbents, because they've been through these cycles before. They have a long memory. If you're looking at an organization like Paramount Global, which used to be Viacom before the CBS merger, Viacom CBS. So a lot of those changes, they've figured out how to survive for the long term. And I wouldn't necessarily put a lot of my money on these new players that have come out from some of these streaming services. In that a lot of the big boys will either gobble them up, there'll be some consolidation. Organizations that have too much debt on their balance sheets, like Warner Brothers Discovery, are gonna find themselves in a crunch. And that's one of the things within media that I think is happening constantly, right? change has been constant in that area, and the business models still have to be figured out. There's going to be relatively ugly some time periods, but for investors, those ugly time periods are where you can find mispricings in the market, right? And mispricings in the marketplace are often how you can compound for the long term. So anytime things are either opaque, something looks strange, things are beaten down, take a look under the hood, right? And you can find beauty in that. And that's how you can compound over the course of time in order to generate potentially superior returns. At least that's our thinking.
Awesome. And that's really good commentary there. I appreciate that. I'm going to shift gears a little bit, and you've already mentioned this a little earlier in this conversation about valuations, and specifically when it comes to sports related and media type companies. And, I really want to frame the question in the sense of that it seems that private investors have a little bit of a different gauge or indicator, right, on how they're valuing these companies relative to the public markets. And so I'm just curious on what they're looking at relatively that's different than the public markets, and how that could potentially lead to an opportunity within your eyes.
Yeah, I think one of the most interesting pieces out there is the valuation disconnect between private market values and public market values for sports and media overall. And I think that it's one of the largest value disconnects that we've seen in quite some time. And I'll use an example, just from some of the company that we know well, which is Manchester United, right? If you're thinking simply, right, what people know the most in the United States is going to be NFL, right, versus a European football club or soccer in America, right? What are the differences between the two? Well, I think that the fundamental business difference between the two of those, NFL versus European soccer, is that there's no relegation and promotion in the context of U.S. sports as a whole. If you do good, you don't get promoted to a better team. If you do bad, you don't get kicked out. Right. What that means is that you can predict your future earnings with a lot more certainty than you can in Europe. Right. And that's also compounded by the fact that for the U.S. leagues like the NFL and the MLS, a lot of those broadcasting rights that we were talking about a minute ago are held centrally. Right. And so they're very much so profitable. And so that means that amongst sort of some of those U.S. based, teams that are held privately, that the revenues are distributed pretty evenly amongst all the teams at the same time. Again, there's a salary cap, so you have a keen sense of how much money you're going to make in a few years. You also have a sense of how much money you're going to spend in a few years. And so with any typical valuation model, right, you usually do it based upon how much money you expect a given company to make over the next few years. And you certainly have the certainty, if the certainty of that is higher, that number is generally going to be a higher valuation. Hence the private companies, the NFL, the dream in there has a higher valuation. In Europe, it's a lot harder to do. Again, you might get promoted, you might get relegated, you might buy a player for 100 million, you might sell a player for around 100 million or so, and all those things create a huge amount of unpredictability in the valuations. It's really harder to land on, and that's why you see that huge sort of disconnect. Another major piece of the disconnect, broadly speaking, is the fact of those private organizations really is the playground for the wealthy. And the wealthy generally got wealthy in another way, through business. And so what they have mastered is the ability to have long-term time horizons. And those long time horizons is actually what gets you that market multiple compounding that we talked about, at the beginning of the podcast, right? And so a lot of Wall Street is really focused on the short term, the near term, which creates those valuation disconnects. If you have the ability to look, under the hood into those companies, again, using, Manchester United as an example, its market cap right now is around 2.3. Recently reported, private valuations for the Glazer family, love them, hate them, whatnot, depending on if you're a Man U fan. The valuation that Bloomberg has reported out is about a $6 billion. That's a huge disconnect, right? if you're thinking about another organization in the context of, Madison Square Garden Entertainment, which again, we hold as well. They, own the Knicks and the Rangers. They own Madison Square Garden, etc. If you look at the valuation disconnect there, the entire company really is trading for, in the public market sphere, what the real estate value is for, Madison Square Garden itself, right? What it tells you is that in the private markets, there is a different mentality that's going on. These are ultimately scarce assets, right? They're not creating any more, generally, Madison Square Gardens in New York, right? There is going to be a limit on the number of European soccer leagues out there, right? And the people that value these organizations in the private sphere are focused on legacy, right? They're focused on truly long-term generational assets, and that's why you see a valuation disconnect. Now, if you are a publicly traded organization that has some of these assets in your book, such as Manchester United, the way in which you crystallize value is at some point selling them, right? And if you could buy something at a significant discount to its intrinsic value, where you know that the likely buyers are going to value it much higher, if you have a long-term perspective, that might be a reasonable bet to make over time.
Yeah, which has been an interesting thing to watch. The last question for you, and it's really more about kind of moving forward in the future. As every company's looking for, they're looking for new growth avenues. They're looking for new ways to monetize their brand or their asset. And so I'm curious on what you think are some of the new opportunities, new ways to reach these new markets for these organizations moving forward.
Sure. I think, one that's on, top of mind over the last couple of months, obviously has been sports betting, right? And the increased engagement that folks can have in the marketplace in the context of whether it's like DraftKings, FanDuel, and whatnot. And that's a new way sort of to monetize and reach really new markets. If any of you or your listeners have been involved in a fantasy league in their office, right? The people who watch the sports religiously are different from the people who will ultimately participate in that fantasy sport, because there's something tangible there that they have reason to get involved. It's the same thing for legalized sports betting. Now, a little bit of a history story here, but legalized sports betting, which is spread across the nation, I think had more than $57 billion in legal wagers in 2021 alone, right? And this is a super new industry because it started with the Supreme Court ruling out of New Jersey that challenged that 1992 law, right? And I think since then, more than 35 states have legalized sports betting, with 20 of those states, and DC, by the way, having operational legalized mobile betting, right? And it's an industry that's really continued to be poised for rapid growth, and we think it can change the game for increasing engagement across the sports ecosystem. The industry saw revenues more than quadruple to about 4.3 billion over 3 years, and that's amid a pandemic that shut sports down for a while as well. So you'd see major sports leagues and companies having benefited from money tied to fantasy sports, as I mentioned before, and now they're going to cash in on that, and they are, making deals with the NBA, NFL, MLB, and oh, by the way, sports betting books have come to the Nationals Park, and they're going to be coming towards Chicago at Wrigley Field in 2023, right? That's a way to reach different audiences. The other arena is with Gen Z, and again, I mentioned this before, but I'll say again, short form video, right? And there's been a long notion that younger people are participating in sports less. They're sitting back and watching less games. And that may be true for teenagers. I know, beyond taking my son, personally to the games here in Chicago, to watch the Bulls and the Bears and the Blackhawks, he's not sitting down watching, full games in the middle of summer, but in the winter he certainly is. But how is he interacting? He's interacting on TikTok. They're interacting with sports on Snapchat. I don't know if you've had a chance to look at those videos on YouTube at all. And this is all being tracked by Nielsen Sports, right? And so they actually had a recent report that said, hey, younger people aren't interacting with sports less. They are just doing it differently than others. People are still engaged. And anytime that you can have interactivity through whether it be sports betting, reaction videos, highlights, if you can translate that into people actually watching the games and or buying merchandise, that's a huge win towards getting to the next generation and increasing eyeballs. The last piece that I'll say is one of the major pieces out there is just take a look at the stats for MLB The Show. You will have kids that have never watched a single game of Major League Baseball, knowing all the players, all the stats, and everything from MLB The Show, right? If you can monetize that by having people pay for microtransactions with branded material and things like that, as kids do, because they're already used to paying for things like that through Fortnite and other stuff, you can monetize those folks for the rest of life as they come, past 18, stop using their parents' money, and then move on into the workforce. And I think that's what's going to keep this growing and alive for the next generation.
Good answer. That's very interesting. And hopefully, being a baseball fan myself, I would just love to get kids involved because I think it's a great sport. And it has lost some of its allure. I personally don't like the pitching change. I don't think they should actually speed it up, but that's, I think, me coming from a traditional baseball perspective. I get it from a business perspective. So you're going to get the diehard fans are like, don't change the rules, but they're probably going to change those rules.
Geriatric millennial strikes.
That's right. That's right. But Dan, thank you so much. We would like to just roll into kind of some of our round robin, and we'd love to have you, have the last comment. So Nathaniel, if you want to start, I'm happy to follow up and we can go from there.
Sure. So I think that we touched on, first of all, again, I want to reiterate that Danan's statistic about how much NFL teams have appreciated over a 25-year time frame. I did not look that up. Swear to God. But in addition to that, I think that we hit on a lot of interesting data that I think it's just quite fascinating to watch. Personally, when I first got into researching sports publicly traded companies and trying to understand what I gravitated to as an investor, I was not as aware of these kinds of concepts as when it came to scarcity or what went into how these sports teams earned money. I learned about the broadcasting deals, advertising and sponsorships, stadium fees, merchandise. Putting all of that together, when I first looked at it, I thought, well, this is kind of a cyclical thing because it's based on how well the team is doing. If the team's not winning, then they're probably losing money. Well, it turns out, yeah, they are maybe losing money, but it's typically due to tax deductions of which some other companies may not even be able to utilize. For example, when it comes to sports teams, owning them, you can deduct a good portion of the price paid over a 15-year time frame, depending on how you allocate the price. That's very similar to when you think about a company buys a piece of equipment, you depreciate it over time. Well, this is some would call it a tax loophole, some would not call it that, but this is a means of sports owners to essentially do the same because they are depreciating an asset over time. There are these kinds of unique characteristics to owning sports teams that I think that, to your point, Danan, if you properly research these kinds of teams that are available for public investment, that there can be a lot of value to be found. Tim?
Dan, again, thank you for joining us. And I learned a bunch, actually. It's been fascinating to listen to, especially in the sports realm. I'm going to pull a few quotes from you. I'm going to pull a Dan here, our other partner. One of the quotes that I really liked is you said, maybe you just need to stop and look under the hood, and then you can find some beauty. And you mentioned multiple times to do the work. And I think we talk about that a lot, that in order to probably drive that value, you have to do the work. And just because a car may not look great, that engine may look beautiful inside. And so I really like that quote a lot. The other one that I really enjoyed that you said is that the world just doesn't change that fast. That's a really good quote for a lot of different reasons and a lot of different ways. Which really is just great to know. It's a great reference. It's a great thing to take a step back, where I think day to day you think things change really fast, but over the long term, if you kind of take that scope out, it really, you're right, things don't change that quick, and it's good to know that. And which brings me to my last thing that you mentioned, which was very fascinating for the valuation discrepancies and why these owners have been able to compound these companies or these organizations over the long run at extreme rates, and that it's a long-term time horizon. If you really want to boil it down to, it always comes down to time and being able to have that time horizon in order to make strategic investments over the long run, and not be forced to do things in the short run to gain a short-term gain. It's so powerful, but so misunderstood and so hard to execute all in the same breath, and able to do that. So again, that's one of the reasons why we like Ariel in general, is because you approach the world with that long-term mindset, and you like to find that beauty in those opaque looking cars that have those nice engines. So I just really enjoyed those quotes that you mentioned. I think they ring home in a lot of different areas. So thank you. But I will let you have the last word. So please, by all means.
Yeah, when I was a teenager, when I was in high school, I used to like street racing, and I came up to one of these cars and it looked like a piece of junk, right? And got it to the line and everything like that, and it absolutely blew me away. I had a nice car, it was polished up, and then I realized like, maybe it's the engine that's actually going to drive this. It's not how shiny or nice the paint job was. It can be that same way when it comes towards value investing. My actual last thought is get involved in your community, right? No matter where you sit from a financial standpoint, communities are what matters. Find something that's near and dear to your heart. Find something that you believe in, whether it be a charitable organization, philanthropic giving. Don't forget to give back. Financial literacy is something that we hold near and dear to our heart here at Ariel Investments, and so we have engaged in building a school that teaches financial literacy. But everyone can give back in their own way. It doesn't have to be in raw dollars. It can be in kind. It can be your time. But make sure you give back to your community. Thank you both for having me. It's been a wonderful experience and a great conversation.
And thank you for joining us, Danan. We really appreciate your time. And to our listeners and viewers out there, we hope you have a pleasant evening. Thank you.
Like and subscribe.
Thank you for taking the time to start your journey of thinking differently and listening to LBW talk about stuff they love. Until next time.